Up in today's show, the S&P 500 has its worst week since the Silicon Valley Bank collapse. I do a deep dive into Apple stock and its hard fall today, and where I think the price may go and what it means for the market overall. Amazon up big on its blowout quarter. Jobs report comes in weaker than expected, and more trouble for Carl Icahn with his stock down 30% today. Hey, what's up guys? Hope you're having a great start to your weekend. You're now tuned into the Click Capital Daily Show. My name's Jared. I'm going to run you through all the most important news, data, and charts from the markets today. And we've got an interesting one today with a big fall and Apple, so stick with me. And hit that subscribe button if you haven't already, as I do these shows every day after market close. And so it was a bit of a soft finish to the week here, with obviously Apple, the big one, down almost 5% today, which I'm going to get into shortly and cover everything you need to know about it, both fundamentals and technicals, along with some valuation analysis, and whether the fall in the biggest stock in the market will drag the rest of the market down with it. The big contrast today was Amazon, which came in with a much better than expected quarterly earnings result, and the stock was up over 8% today. Other than that, a bit of bearish breadth across the board continues. So the biggest news in the market today was the fall of Apple's stock, down almost 5% here on more than double the average daily volume, and we finished pretty weak right on the lows. And this has been the biggest move it's had in quite some time, and it looks like we've clearly broken this tight parabolic trend line that's been in place all year. And Apple has been on quite the run this year, getting up to almost 60% high from where it started. And why it fell so hard today was on the back of yesterday's earnings, which showed a third straight quarter of declining revenue. And so the market will really be looking to their next new iPhone model, expected to hit the market late next month, in order to start driving revenue growth again, which hasn't been above 10% since 2021. And the biggest reason for that is the slowdown in their hardware category, which drives the majority of their revenue and profits. And it's really the last couple of years, their services that have helped drive growth with Apple and the market to assign it a higher multiple. And that's with things like iCloud, Music, Apple TV, and that category is still growing, up 8% from the year ago. And of course, Apple is a very strong brand, if not the strongest brand in the world. And with an installed base of 2 billion active devices, it'll always benefit greatly from that network effect. The question is, does it deserve a price to earnings ratio of 32, given now that we are seeing declining revenue and earnings? And stick with me, I'll get into the valuation in just a little bit here. Also adding fuel to the downside on Apple stock today was a downgrade from an analyst, which says the slowdown in the US business and iPhone sales is likely to continue. And it's not just iPhone sales that was seeing a slowdown as well. Mac sales were down 7.3% from a year earlier. iPad sales were down 19.8%. Wearables did grow 2.4%, and it was those services growing 8.2%. That is really the bright spot for the company. However, sales in the Americas were down 5.5%, and CEO Tim Cook blamed that on a soft market for smartphones. But Wall Street analysts are still optimistic on the stock. Overall, they have a buy rating at 4.06, with the average price target at $196 a share, which is about 7.7% higher than when we are today. And just looking at the average price target over the last 3 years versus Apple's stock price here in the blue line, we can see most of the time Wall Street is generally pretty optimistic on the stock, but this last couple of months the stock has consistently traded above Wall Street's target up until the last week when we've fallen here. Just looking at what the computer thinks of it with some quantitative rankings. Valuation scores really poorly at an F, which I'll get into in a bit. Growth now is a D, now that it's declining. Obviously still a very profitable company. Overall, in the last 6 months, there is still momentum in the stock, and earnings revisions are trending the wrong way as well. Just looking at insider activity in Apple shares, hasn't been much activity of late. We did see half a dozen or so company insiders offload stock back in April, and quite a bit as well, about $70 million worth of stock, including CEO Tim Cook, which sold $9.2 million worth of share at $165 a share. And just looking at dark pool activity and Apple shares, looks like overall dark pools are short to the tune of $2.5 billion, and they have been short pretty much all year since early March, but they've pulled back a bit on their shorts in the last couple of weeks. Just looking at the options market for Apple, still primarily call options, with the put call option ratio at 0.9, and the option market doesn't seem too worried about Apple just yet, because the skew is still really low. And that's a chart of the 25 delta put implied volatility minus the 25 delta call implied volatility. So right now on average, puts are only 2 implied volatility points higher than calls. And so back to the chart on Apple. It was only 2 weeks ago we came up to the all-time high just below 200 at 198 a share. Hit that big psychological milestone of $3 trillion market cap, first company to ever hit that. And technically speaking, it looks like there's a bit of damage done here today. Whenever you see the biggest company in the stock market make a hard and sharp move like this for whatever reason, on huge volume finishing near its lows, down almost 5%. That's technically damaging for the stock and the market as a whole, as that can change the psychology of the crowd and start showing a bunch of investors losses on their position. And the deeper we go, the more investors will start showing losses, and that can feed onto itself and create a full-blown correction. But just looking at the weekly chart here, price action only of Apple, it shouldn't be that surprising that we get a pullback and correction. We have been on this super tight parabolic rise all year. And the question is, it will just be how big of a correction do we get? And just looking at the Fibonacci, if we correct 38% of this move, that'll take us down to about 170. A 50% correction will take us down to 160. And a deeper 61% will take us down to 152. So just based on technicals, we could get that correction and just profit taking and just a bit of a rotation in the market overall. But it could also be a fact of the market kind of repricing the valuation on Apple and what should it be. Because right now we're at a price to earnings ratio of 32. So how you work out the earnings yield for a stock is you start with 100 and then you want to divide it by the PE. So currently 32.13. That means Apple currently has an earnings yield of 3.11%. Now just looking at the United States 1-year government bond yield, that's currently 5.33%. And being in the United States, that's the safest counterparty in the world. So assuming no growth in the yield of the bonds, and if the Fed is done, then those bonds will actually increase in capital value in addition to your coupon. But let's just for a moment assume that there's no growth. Just like in Apple, there's no growth. There's actually a little bit of declining growth in Apple. So the market may be repricing it because currently the earnings yield on Apple is 3.11%. And remember, you can't look at stock valuation in a vacuum. It's all relative to the risk-free yield you can get from US government bonds. So right now, short-term government bonds are more than 200 basis points, 2%, higher yield than Apple's earning yield. And if you're looking strictly at dividend yield, currently the dividend yield on Apple is just 0.5%. And this is versus dividend yield on the high-yield corporate bond ETF HYG of 5.8%. So my point is there's a lot higher and safer yields you can get out there for your money compared to Apple. So just looking at this price action in Apple this year and climbing almost 60%, one would look at that and think, well, this company must be growing revenues like 20-30%, or even something like Tesla, which is growing at 40%. However, like we just saw, we got the third quarterly revenue decline. So it's actually going backwards, it's not growing. And sure, we've got the new iPhone coming up and going into a new cycle. However, it was a really strong company and economy and market. It should be growing those quarters regardless. And so unless we see a big surprise in the new iPhone cycle and Apple can get back above 10% quarter-on-quarter, year-over-year growth, then maybe that 3.11% earnings yield isn't quite enough compensation for the risk versus the risk-free rate of US Treasuries. And so if Apple were valued at the same yield as those short-term US government bonds, the way we could work that out is by taking the trailing 12 months TTM, basic earnings per share, EPS of 5.98, and then we'll divide that by the 1-year government bond yield, which is 5.33%, and so we'll enter that as 0.0533. And that gives us 112.19. So going back to Apple stock, for us to go down to $112 a share, that's a little bit below where we started the year and back where we were in early 2021. So at $112 a share, it would have an earnings yield equivalent to the US government bond 1-year yield. And just looking at our stock fair value indicator, which anybody can purchase from our site, clickcapital.io, it looks at a lot of fundamentals, growth, future expectations, balance sheet items, etc. to work out what a fair value for the stock is. That isn't too far off that $112 bond yield equivalent as well. It's got fair value at $121 a share. So the point is that 3 trillion market cap and with a PE north of 30 in a 5% rate environment, that might be a touch expensive. And this might be the psychological damage that could change that perception and crowd psychology of Apple stock. And could end up bringing the NASDAQ down with it, as we've got the NASDAQ closing below its 50-day VWAP for the first time in almost 5 months since early March. And we've got the S&P 500 sitting right at its 50-day VWAP as well. And just looking at our sector trends table indicator, you can see we've got a lot of red up the front here. Most sectors below their 5-day and 20-day moving averages. And it's really just oil, gas, energy, and regional banks that are holding up a lot better than the rest of the market now. Another news out today, we've got the July jobs report. Non-farm payrolls expanded by 187,000, a bit below the estimate of 200,000. Unemployment rate actually dropped 0.1% down to 3.5%, and average hourly earnings rose 0.4% for the month at an annualized rate of 4.4%. Contrasting Apple's growth and price action was Amazon going in the other direction today, as they've still got AWS holding up with improving margins and came in with a huge beat of 65 cents versus the estimate of 35 cents. And just looking at the price action in Amazon today, we gapped up hard, ripped up to 143 a share, However, we turned course like much of the rest of the market in the afternoon and finished down near its lows at 139 a share. And it looks like the price action in Apple overwhelmed that and Amazon and ended up bringing the Nasdaq down with it. And I can imagine if it weren't for Amazon up 9% today, the Nasdaq and market overall would have been down a lot harder on the back of that Apple news. So whilst Amazon has helped hold the market up somewhat here today, we'll see whether it can defend this earnings gap next week and potentially hold the market up a little bit. But right now, I think the weight lies with Apple on the downside. Famous Wall Street raider Carl Icahn still getting a taste of his own medicine, with this stock down a huge 30% today. And this is coming on the back of news of his shady company structure kind of unraveling in front of our eyes after he said he had halved the amount it pays out to shareholders. And this has all been brought to light from famous short seller Hindenburg Research, which accused Carl Icahn of using money taken in from new investors to pay out dividends to old investors. He said such Ponzi-like economic structures are sustainable only to the extent that new money is willing to risk being the last one holding the bag. And just looking at his stock, Icahn Enterprises, market has agreed a lot with what Hindenburg Research said. Ever since they first came out after close on the 1st of May, the company traded a bit above $50 that day, and here we are now, down 50%, currently trading under $25 a share as I speak. So it's a quick look at some economic data out today. Saw retail sales across the Eurozone coming a bit weaker than expected and showing contraction, and more signs that the Euro economy is in stagflation. Canada's job market came in a bit softer than expected as well, and there's the non-farm payrolls from the States, which came in a little lower than expected. However, unemployment rate and average hourly earnings still show the United States jobs market is holding up pretty good for now. And just looking out to next week, we'll have some inflation data out from China, and then the big one, Thursday. Inflation rate, CPI out of the States, and it'll be these two numbers here that we're looking at. The headline inflation expected to come in at 3.3%, and core inflation year over year expected to have shown a 4.7% gain. And this is going to be the big one for how Fed Fund futures price in, what the Fed's going to do next. And if this were to come in higher than expected, that could further exacerbate a sell-off in long duration assets like tech growth stocks. However, it could very well come in at consensus, and those high commodity prices we've been seeing of late may have a couple of months lag to them, and it could be the CPI in September or October that shows an uptick. However, the stock market's really banking on that inflation coming down. So if inflation did come in a bit softer, then the stock market should hold up on that. But on the back of that softer non-farm payrolls report we got today, Fed Fund futures just slightly dropped their probability to 13% that the Fed will hike later next month, and about a 1 in 4 chance they'll have it done by November. And like I said, these numbers here hinge greatly on that CPI report next month and the one after that in September, which will come a bit before the Fed meeting. We usually get the CPI reports around the middle of the month. Fear and greed index back down into the greed zone, and another typically busy day in the options market. Almost 49 million contracts traded, and still mostly call options coming in at 54%. And just looking at international stock indices, and Friday's session appears to hold up not too bad across the board. Did see a little bit of a pop-up in volatility. Still got the term structure in a normal contango state, but is flattening a bit up the front here, with VIX 9-day and VIX 30-day just a point between them. Volatility risk premium growing again, shooting up 21% today, now currently 8 points above realized, and a little bit of a jump up in the equity put-call ratio. Maybe a bit of insurance hedging buying here going on the back of these moves from Apple, and the skew as well, breaking out close to year-to-date highs, 153. The price of that tail risk out of the money put options increasing. Further deterioration in short-term breadth, now only 37% of stocks above their 20-day average, and stocks making new highs, pulling back significantly on the Nasdaq, just 44 today. Still seeing weakness in the defensive sectors. That's why we've got the growth defensive spread still holding up. Same with high beta stocks. Small caps still in a short-term uptrend versus large caps, and the commodity growth spread, copper versus gold, back down underneath its 50. A little bit of a pullback in government bond yields today. Got the 2-year at 4.77 and the 10-year just above 4%. Pullback in yields gave a nice little pop to TLT, and the dollar just below 102. Commodities still doing well. Gold still just sitting just under 2,000 an ounce. Oil finding new multi-month highs today, above $83 a barrel. On the back of news, a Ukrainian drone struck a Russian oil ship, further disrupting supplies from that region. And over to stock sectors, got a bit of a pullback in the meme space today, down 4%. AI bot sector, still on a short-term downtrend. Same with highly valued stuff in ARK. And there's a look at the strongest sectors in the market in the short term: energy, oil and gas, and regional banks. And we're not seeing much of a rotation into defensive sectors on the back of this pullback, because we've got healthcare, consumer staples, and utilities all trading pretty weak, and more so again today, with utilities now being in short-term oversold territory on a bit of a bullish divergence on our hidden divergence indicator here, and sitting at this major support. We've seen it last bounce off a few times this year. BlackRock still underneath its 50. Just a quick look at Apple after hours as I speak. There's normally not many big moves on Friday post-market session. So the market kind of closes up for the week. We don't get any more earnings results in that time either. And this will be the big one next week. We're going to keep sliding on the downside. This is a pretty strong, damaging technical pattern here, finishing down hard on its lows on big volume after a big parabolic rise. And the other big one will be Amazon. Can we hold this earnings gap? Will that hold the market up? And of course, all those other ones in between, like Microsoft in a short-term downtrend, Google holding up with its earnings gap as well. NVDA still above its 50, and Tesla looking a little bit weak here. And just a quick look at the meme space. Actually had Tupperware gap up today. One of the strongest stocks the last couple of months. Carvana had a bit of a pullback here today. Same with Nikola, down 26%. Real estate stock, Redfin, falling 24%. And cybersecurity stock, 14net, down 25% as well. And these are some big moves for a large company like this, 44 billion. And that's not typically something you see in a bull market. You always see the occasional gap down, but when you see lots of these big ones, like we have today, seen some pockets of some big sharp selling and on big companies as well, that's usually a sign that the ground below us could be a bit loose and we may have not found a floor just yet. And there's just a look at the big banks, which have been a little bit soft but still overall holding up pretty good. Okay, back to the main indices. It looks like we may have rejected off this big 4600 level in the S&P 500, and similar story with all the other indices. Here's the equal weight S&P 500. Maybe look to have found some resistance, and this is definitely a reversal candlestick pattern here. Same with the Nasdaq, which pretty much looks like the price action of Apple. There's a Dow Jones Industrial, mid caps and small caps as well. Look to have come up to areas of resistance, and we look to at least be consolidating here, which could then turn into a full-on leg lower. And there's a look at the weekly chart of Amazon, which really helped the stock market out today. And if it wasn't for this, like I said, would probably be down a lot more. And I think we could call this a bit of an area of interest as well on Amazon stock. You can see we've turned multiple times in this area before, around the 145 level. We did ping off that a little bit here today, and this will be one of the key ones to watch next week, Amazon, the price action and that. Whether it can hold this earnings gap or retrace it, and of course the big one, Apple, whether we get any more follow through on the downside. Then of course CPI inflation data on Thursday, and as always, keeping an eye on the price of commodities as a big input into inflation, and of course the US government bond yields as well. So we'll just have to wait and see what happens. But that's all for this week. Thanks very much for sticking with me and tuning in to the Click Capital Daily Show, everybody. Appreciate your support of this channel, and I hope you all have a great weekend. See you Monday afternoon. Cheers.